Hi, good afternoon. We're going to be talking about the soft drink industry and the fast food industry today. So let's begin with the soft drink industry. It comprises of the production, marketing, distribution of non-alcoholic, generally carbonated, flavored, and sweetened water-based beverages. It constitutes a quarter of the entire U.S. beverage market.
The key players in the market are KO, the Coca-Cola Company, PEP, PepsiCo Inc., and DPS, Dr. Pepper Snapple Group. As you can see on the market cap chart, for the industry giants, the market cap is $175.68 billion for the Coca-Cola Company and $118.66 billion for PepsiCo Inc., whereas it's only $8.99 billion for Dr. Pepper's.
There's a large soft drink dependency in the U.S. About 60% of Coke's revenue in the U.S. is derived from carbonated soft drinks, compared with about a quarter at PepsiCo Inc. And more than 70% of sales at Dr. Pepper Snapple, the number 3 player, are from soda, and about 90% of its revenue is from the U.S.
As seen in the revenue chart, the revenues for the key market players have been steadily leveling off. A drop in the U.S. soda revenues would represent a serious blow to the entire soft drink industry. The industry is currently under a great deal of stress because Michael Bloomberg, the New York City mayor, is trying to limit the size of the soft drink distribution.
He's been running this proposal for the past few months. He's trying to limit the serving size to under 16 ounces for the sugary water soft drinks at places like restaurants, stadiums, or arenas, and etc. However, yesterday, on Monday, March 11th, the proposal was slammed by a New York City judge, saying that this was beyond mayoral decree. However, this is still not good news for the industry, as with an aging baby boomer generation with declining consumption of fizzy soft drinks, as well as a youth that is changing consumer preferences, that is substituting coffee and energy drinks for these fizzy drinks, soft drinks are losing popularity in the U.S.
According to the statistics, soda sales has declined 0.6% during the past year, and in terms of volume, the sales has dropped 1.8%. Now let's look at the net income graph. The 3 key players in the market, their net incomes have been declining and is projected to decline even further.
However, if we consider the revenue chart of the substitute products, exemplified for coffee by Starbucks in this case, and for energy drinks by Monster, we can clearly see that over the past 5 years, the revenue has been steadily increasing. In fact, Monster has gone up approximately 30% between 2011 and 2012. Similarly, if we consider their net income chart, their net incomes have been rapidly increasing over the past 5 years.
In response to these trends, Coke, Pepsi, and Dr. Pepper Snapple are all aggressively expanding their portfolios to move away from the purely carbonated flavored beverage market from before to include faster growing products like sports drinks and fruit juice.
In conclusion, the soft drink industry in the U.S. is likely to shrink as legislative pressures, along with changing consumer preferences, decrease profit margins.
So now we're going to be talking about the fast food industry, also known as the QSR industry. QSR stands for Quick Service Restaurants, where full meals are served without wait staff, such as McDonald's, Burger King, Taco Bell, and Starbucks.
The key players in this industry are McDonald's with the ticker MCD, Yum Brands with the ticker YUM, Starbucks Corporation with the ticker SBUX, Chipotle Mexican Grill Inc. with the ticker CMG, and Dunkin' Brands Group Inc. with DNKN. As you can see on the graph, the market capitalization for these organizations are $99.17 billion for McDonald's, $30.58 billion for Yum, $43.92 billion for Starbucks, $10.01 billion for CMG, and $4.06 billion for Dunkin'.
The industry has been the eye of investors. It's one of the areas they can count on for growth in the broader retail and restaurant segment. And the reason is because retail is saturated by the likes of Amazon and mass merchants, and there are not a lot of retailers with unit development growth. So what we've seen is a rotation in the restaurants industry.
Now we're going to talk about a couple high-performing QSR restaurants from last year. First, we're going to talk about Good Times restaurants. Good Times restaurants certainly had a good time on the stock market last year. The Colorado-based burger chain used growing same-store sales and a new breakfast menu to help double its stock price during 2012, making the company the best equity performer among restaurant chains for the full year. The second best QSR stock performer in 2012 was AFC Enterprises Inc., the parent company of Popeye's Louisiana Kitchen. Its stock increased 77.8% over 2011, thanks to strong sales and earnings.
During the past year, quick service restaurant shares outperformed the overall stock, driven by an optimistic outlook among restaurant operators. The National Restaurant Association Restaurant Performance Index, RPI, rose to its highest level in 5 months. The RPI index is a monthly composite index that tracks the health of and the outlook for the U.S. restaurant industry.
Now let's consider the sales outlook graph, which shows that restaurant operators' outlook looks positive for continuing sales growth. In addition, for the first time in 4 months, restaurant operators will have a net positive outlook for the overall economy. Quick service restaurant sales are expected to total $188.1 billion, up 4.9% from 2012 this year. Although business conditions are expected to remain generally positive, operators in QSR segment will find healthcare reform as their top challenge this year.
As the world continues to crawl out of a major recession, the fast food industry, especially QSRs, should continue to grow as consumers search for affordable and quick eating options. With more and more alternatives, there is an option for everyone, from the traditional burger and fries to healthy salad. With increasing competition among brands and industry categories, fast food chains will have to differentiate themselves and constantly adapt to industry trends and new marketing approaches.